I'm a winner, but I recognize and respect that I have the potential to lose a lot of money today. That's why I'll make today's number one priority to not lose more than my defined maximum risk. My only job is to manage risk and allow my profits to take care of themselves. The market is irrational and unpredictable. It will go lower than I think and higher than I expect. I recognize this constant unpredictability by staying humble. I respect the market today no matter how good or bad yesterday was. One day can't make me rich, but one day can make me poor. One day at a time.
We've had that weekly close on Bitcoin. Real momentum killer for the downside. So shouldn't go below 60. Likely above 80 either. And probably not for quite a while. That's a huge weekly. Like we did last time we bottomed. I ended up spending, I think it was 8 weeks before trying to break out of it on the 9th. This inside week that we had seen. We picked the weekly high and low. And we cleared inside of that. I expect something similar. Certainly this week, with opening at 70, which is right in the middle. Got to keep that in mind for last week's range. We're right around the midpoint. We still have high enough volatility. There should be a decent move this week, given that we closed around 70 and we're now below it, and we've gone as low as 68. I would say probably 65 to 75 maybe, if we get some upside. Or just if the peak comes in the low 70s, we could go to the mid to low 60s. I really don't see anything else for Bitcoin other than an inside week here. It's very, very hard to expect this to go lower after such a large capitulation and not coming out of nowhere. Well, not so much not coming out of nowhere, but you can see this weekly that dropped straight from consolidation, got bought back up, and then immediately retraced the full thing the next week. And even that was still a sign of the bottom, because the strong demand, even though there was a big flush, was an indication that when it got retested that the underlying demand was solid there. But in a decline, where price has been moving lower, and we get these multiple breaks lower, it's hard to see it going beneath this week's low or having enough momentum to get to new lows. I mean, you've seen the reports and stories like Fear and Greed hitting 5. Everyone's convinced it's over. And you could argue this maybe, this weekly, but again, I would say that was not in a markdown. That was coming into a prior low and it was trying to hang on, and then we got the markdown. It was really like the first break away from consolidation, which led to the next 2 big weeks. This week is much more like this week, in that you have had a breakdown, had a clear breakdown the week before, breakout from prior consolidation, and you have a big, expansive, volatile week that closes with some demand, closes with a rally, and you just almost certainly stay range bound after that. It goes both ways as well, upside and downside. You see such demand, you see this crash candle from August getting bought back up, we stay inside of it, we move to the highs, we move back to lows. It just sets a range for price to consolidate in. It's hard to see anything else really at this point. Even throughout some of the deeper bear market crashes, you still spend 4 or 5 weeks before you start moving lower. Same here, even in this very bearish scenario with Luna collapsing, if that collapse candle spends 3 weeks, 4 weeks, and then breaks it. And of course here you spent like 20 weeks inside of it. Even when it was bottoming out in 2021, same thing. You get that demand at the end of that move. Price spends 2 months trading inside of that. That was bottoming out. That was putting in a floor. So I don't see any other way for this really to go. When you look at upside moves, it's the same thing. Like when you have this exhaustion move at the end of the rally, price does not go any higher, eventually consolidates inside and reverses, which in the case we're in now would be like the opposite. And it's the same at the peak as well. You get these 3 big weekly candles. The fourth happens to be red, but it's a sign of a momentum exhaustion. The next week, price trades narrow, takes out the lows, stays inside. 2 weeks, 3 weeks, fails it and reverses. That would look now would be a reversal for BTC. So even in this fastest scenario of reversal that you could imagine, which would be extremely quick, it would be like the equivalent of seeing that we've had this final impulse, and you give it 2, 3, 4 weeks, possibly test the lows, but you're talking a month or more before price would reverse. The sign of that, of course, would be how quickly does it reverse the final leg. You see that sharp move up, full reversion, big sign of momentum weakness and reversal incoming. If price were to do that, you could see Bitcoin moving to the upside. I'm not in that camp necessarily, although I do think going back to the mid-range is a target if price stays above the 50-month, and if we see daily structures forming, which we don't have yet. So right now, we have wide daily ranges. We're staying below the daily bands. We're in the midpoint of last week. Saturday, Sunday are less volatile, more narrow range than the midweek. So I think today picks up a little bit. And we should still see a little bit higher volatility before it starts to really squeeze and slow down. You can see how wide apart the daily bands are. We still haven't even tested them. That's a sign of extreme oversold conditions. You obviously know from last week what the driver of that was, breaking through 80, 70 and then down towards 60 with that massive capitulation. Price needs to catch its breath. 60k was 60, 61, 62, 63 great buys for certainly from a low time frame perspective to catch anything there and take profit for like a scalp or a multi-day trade. For long term, any crash is good to buy for Bitcoin like this long term, as I mentioned in Beyond Bitcoin last week. But what's not is when it reacts higher and it goes from 60 really quickly to 71, and you get that typical, always you get this wave of, oh shit, did I miss the bottom? So in the short term, look, chasing this up and buying above 70 again for people who wait 5 years, it looks like a great entry. But in the short term, it's very typical that is too soon. You don't buy into the first rally. Either you buy the bottom of it through having orders placed, or just not using a system, you're just taking some long-term stack or whatever. But the first reaction after a large scale liquidation, forced selling in this case, as I see more happening in options with IBIT. We've just retraced right back into the lows of Wednesday. So there was a large gap left, or potential gap left, with this impulse. It was a huge double impulse move down. Friday filled all of it back up, right back into the Wednesday lows, retested it fully. So it's just fully reverted the move. So the mean reversion has been completed. And it's likely now, Friday filled back into the lows of Wednesday. So there was a large gap left, or potential. Gap left with this impulse. There's a huge double impulse move down. Friday filled all of it back up, right back into the Wednesday lows, retested it fully. So it's just fully reverted the move. So the mean reversion has been completed. And it's likely now to find that as resistance and move back down to test some of these levels below. Because most of what came after the true bottom and the real pocket of demand that got hit between 60 and 62, everything that came after that was automatic reaction. So we've got an automatic bounce, which when you look at the open interest, funding, Coinbase premium, you can see all of this really clearly. Massive build up, short squeeze. And not a short squeeze that is hurting the bears. The bears certainly are not hurting in the last few weeks unless they are terribly positioned. Which of course there will be people shorting into the lows. But this entire move did not take place on centralized exchanges. That was not the driver of it. You can see that people always, I think there's this shallow logic people have where they always think that it's like crypto retail wrecked, and they always share that 300 million, billion, trillion were liquidated. All that liquidation stuff's nonsense in terms of the numbers. The numbers are never correct anyway. The numbers are always made up because exchanges don't broadcast liquidation data in the same way. And oftentimes, especially if you look at Bitcoin and you're not seeing it, if you're not seeing as it falls, you're not seeing open interest get wiped. Again, just go back to the 10th of October. It's really simple. That is a liquidation event. That is people getting wrecked. That is mass, wide-scale liquidations. Absolutely. You had a price at all-time highs. You had positive funding. You had a sudden sharp drop, and you had a massive spike in the Coinbase premium, which just meant that obviously Binance were selling heavily. And then this move was totally opposite. Even the whole way down. Like the open interest, the positioning wise, the net open interest is higher than it was on 10th of October, post crash, say the 11th or 12th. So net centralized exchange, because remember, this is just Binance, Bybit, OKX, Deribit, Hyperliquid. This is just centralized exchanges. This is not CME futures. This is not options markets. It's not spot, obviously. It's not like Coinbase spot. It's not even any of the IBIT options. It's not any of the other structured products and TradFi ways to get access. This is only what you would call offshore or crypto retail, because that's who trades on Binance, Bybit, etc. It's people that are non-US, not institutional Wall Street types. It's going to be those outside the US, so globally. Could be institutions or big entities or big traders, big firms, but it's not the US regulated ETF / CME futures where people call the whole Wall Street institutional capital, which is happening on Coinbase spot, ETFs, CME futures, and ETF options, IBIT. There's none of that. So this wasn't a retail getting wrecked type of move. You also see that from the crash. On the biggest red day, you had open interest up, not down, and then on the green day, you had it down, not up. So it's the opposite. So there was obviously some hedging or some. I said at the time, you can even see by the way that it's moving, and it was like this all the way down. The open interest kept doing this. I kept mentioning over the last few weeks. Watch when open interest rises as price falls, and then so it starts rising at 105. We go to 81. Open interest straight up, while Coinbase premium straight down. So Coinbase selling heavily, shorts adding heavily, but clearly these are not like retail degen over leveraged shorts. This is very much professionally executed, let's say, and it's likely hedged. So they're trying to hedge a bunch of selling, because then whenever the selling is completed and when Coinbase premium into its discount, its negative premium peaks, and it starts to roll over again, and price comes off the lows, and open interest comes down as they typically are closing out, they're rolling off those hedge positions. It's done in a very structured, orderly manner, and price comes back into a lower high. That's how you know sellers in control. They sell and short down from 105 to 81, and it all rolls off back at 94. And this was happening over and over and over. It was happening throughout all of this move, and then it began again. This time was much more aggressive, but you could see spikes of it were starting to build up here at the breakthrough of 90. spikes up when we go down to 80, basically 90 down to 80. You have this big uptick of open interest. What happens when it all rolls off? Where are you? When it all rolls off, you're still in the 80s. Doesn't get back to 90. So they short it down with the heavy selling. Another peak in Coinbase, negative premium. Rolls off. Same again. Well, not same again here. This is probably the one part where we saw price slowly kind of drifting lower and open interest continuing lower. Again, not an indication of large scale liquidation, wipeout, sell off. Mostly because there's no significant retail leverage left in this market, obviously. You know that now. 10th of October, wiped it all. And of course, a lot of that was, fuck off, I'm using VPN. 10th of October was, does this have an aggregate open interest for all exchanges? No. But anyway, you know the 10th. I was just going to show that for all the Bitcoin wiped, alts got completely obliterated. And in that environment, which we've been in, and now Bitcoin itself has gone down a total of 52% off the highs. There's a difference as well in like a slow bleed, a slow sell-off versus a faster one. This is a slow sell-off in terms of the time between the pushes. So you get your crash on the 10th, it doesn't go lower again for about a month. It touches the lows and then it's not crashing through the lows. If you go back to 2021, that's 2021.
tight stops, tight entry, really tight invalidation, high leverage to try and catch big moves. Don't forget that when the daily moves are wider, the ranges are bigger. You have to allow for that. In lower volatility environments, the price moves less. In these higher volatility environments, what would be a massive move in a normal week, like even this single 1 hour candle went from 72 to 70. You're talking like 2.5% in a single candle, almost. And that is what creates this whipsaw effect. And I can be like, oh, we're so back and it's so over. And no, it's all relative to where we've been. I think that will probably come down into the low end of this Saturday move, and we have this consolidation that we're in. Probably come down to the low end of it. Likely we'll end up back in this area here at some point, because anyone chasing after missing the bottom and chasing in will likely get those positions tested. I just got to see where the market settles down this week. With ETH, it's come down into the 2K area. It's actually the squiggle that I drew out last week for ETH and Sol. ETH followed it one pretty well. Main thing I mentioned of that was capitulation would look like going below 2K, which it did. It's got back above 2K. Is there enough juice in the market for a bigger rally? It depends. It makes sense to collapse below 2K, and that would be a place where people would, give up and unwind more positions, which could allow some room for a rally. I've already seen that 1700 up to 22, and it's going to broadly follow Bitcoin's back into resistance, so better watch for that this week. Same as Sol. Sol, a lot of people would have been betting on 100 to hold. That's why I tried to hold 100, didn't hold. Went down to 25 lows, went down to 90, went down through 80, went down through 70, and then got a sharp reaction. So I thought capitulation on Sol would look like towards 80. It actually ended up going all the way down towards almost 60, which again creates this gap that it can trade back up into, all being resistance, but leaving room for, if we don't see follow through selling, that there could be some reaction moves higher. Over into stocks. Just going to watch today play out. So there's not much else to do. Pre-market, SPY is trading just right around where it closed until it sees clearing above 700 and holding on a weekly basis, or clearing below last week's low on a close basis. There's nothing to add there for S&P. For NASDAQ, same thing. Touched on it with Beyond Bitcoin yesterday. Well, not quite the same thing. Obviously, NASDAQ has shown a bit more weakness, but that long wick on the end of last week can be a sign that it's going to hold and stay inside and consolidate, or like you've seen with some of those sell-off moves. The bigger thing here is that you had 2 red weeks in a row when all of the big tech bar Nvidia have reported earnings. So those would be news events that should be bullish, and they've produced failures to move higher. So be watching for sellers this week. Do they follow through or not? We've got a couple of those news and data release with jobs and inflation. And then I think there's another week until Nvidia earnings, which come on I believe it's the 18th or 19th. So it's going to be next week. Not back down to 16 yet. So far, it's crushed down on Friday, up a little bit in the pre-market. Got to see, does that volatility finally come back down to allow the markets to have some relief, or is it going to stay persistently higher? Gold and silver, just a quick look off the open. Still seeing that greater overall strength on gold as it made no new lows. Silver did make a new low, has had a good reaction off that, but since the open, pushed up as high as 82, back towards 80, so that's the big number. It's around gold, right around 5k. So those are 2 levels to watch, 80 and 5,000. And that's the overview. Monday's a day to just watch. Got to see, with Friday's moves, got to see how that follows through into the new week. Yeah.
Good morning, outside.
Welcome to the real world.
buy Bitcoin, breathe air. There's no second best, okay?
GM. So, trade of the day. I think it is fairly simple. It's best to keep it simple. 60k lows, 70k is the proper resistance of the first bounce. So mark off 70. And it's common, just like on the way down, it's common to overshoot to the downside, which we saw with that last push below 62. It's also the same on the reaction bounce. I think 70 is the true resistance here, where after the first automatic bounce, sellers would show up at the first resistance point at the round number. 70k a big level for many reasons. And the fact that it pushed a couple of times beyond that would be normal in the context of these moves overextending in both directions. And as it came up down into 60, obviously a lot of bid depth, buyers showed up, price held, rallied up. Where the selling started to flip, as soon as we got to 70, you saw all the 10% and 2.5 flipping, in particular those deeper depths at the 1 and 1% on the spot and perps. We saw that kind of flipping back and forth, and there's a little bit of demand here, but price is moving against it. And I think that's pretty clear. 70 is not support, 70 is resistance, and I think that 70 is the place where you're badly positioned if you're long in the short term. Where is going to be a good spot? Where is demand going to come back in? That remains to be seen. But I would imagine this does sell off, either from here or possibly from one more test of 70. I think it makes its way back down into some of the, at least to the midpoint towards 65, to start searching for spot demand. If you've got heavy spot selling, that's all cleared out for now, unless there's another wave. You have that big unwind on IBIT and everything else. You get your reaction rally, shorts covering, a little bit of on Friday, a little bit of Coinbase. I think the Coinbase premium reverting back from deeply negative to about even or a slight premium. It was not so much heavy buying or aggressive demand, it was just the unwinding of the prior move and reversal of it. Some buyback of what would have been sold on Thursday, of course. But the actual passive demand, so the spot bid, where is it? That'll only be found and known when we drop. And I'm not shorting here, but I'm expecting it to hold at 70. And I might short here, but not at this point. I'm not saying it's going to go like that. But I think until there's a very clear sign from price that 70k is not resistance, it seems to be very much the actual resistance. And the fact we pushed onwards towards just shy of 72 doesn't make 70k any less valid. I think it's just overshot a little bit, and on the weekend it pushed up to take out some of those early short stops. And below 70 we go lower. Seems pretty simple. I don't even think we'll hit 70, most likely, if that's right. It'll stay below it and it'll start breaking lower, because if anyone's poorly positioned now in the short term, it's going to be longs, not shorts. And that'll be because when it's down, it's crashing, you know, people will step out of the way. They'll not buy, they'll think it's going lower, or they'll get stopped out, or they'll get stopped out on longs so many times that they'll give up and they'll panic or whatever. And then it seems like the market settles and it rallies, and that's where your FOMO buying begins. So in the short term, there's got to have been some FOMO buying chasing back in above 70. That's normal. Drop so far, you rally up. People always buy into the first bounce. Where's 70 going to be in 3 or 4 months? Where's it more likely to be, a support or a resistance? I don't think there's any signs of 70k being a good support. We blew straight through it. So for that to happen, for 70k to become like a good entry point, which is what you're looking at, is it actually good to buy at 70 here? I don't think so. Obviously 60 is a good place to buy, which means you probably don't get it so soon. I don't think you drop all the way back unless there's potential for lower. But to see 70 as a good point, you'd have to see price come down, get well above it, come back and retest it. And that's where 70 could flip to a good spot. They need to go significantly higher. And I don't see that incoming. I think most likely we're going to see Bitcoin trade back towards the middle of this week, not week, but the Friday to Saturday move towards 65. Probably not all the way down, but I don't see it going higher this week unless we're able to reclaim above 70 and stay there, which would look like the dip down. So, closing in on Friday, it did close above 70. The dip was on Saturday. This next dip is off the weekly open. So the weekend dipped into it, pushed back up. The early week, if this holds and comes back above and we start to trade above 70, that's definitely a setup for continuation. Maybe start moving into the mid 70s. But I would be of the opinion that this is 70k resistance until otherwise proven. So the closer we are to 70 without reclaiming it, the more likely it is that we see it go lower towards Saturday's lows at first stop, 67k area, and then likely down towards 65. So I'd have a not so much bearish lean, because I think this is neutral and overall we're going to spend time consolidating. I just think that on the first rally that has exhausted itself. And with so much downside, obviously the sellers are sold out. So it doesn't take as much for price to rise when you've had such a lengthy decline, which has been one-sided, selling only, just heavy selling all the way. So this can drift higher on very low volume. It doesn't need that much, but that's where you want to be looking at demand. Where does price stop on the pullbacks? Maybe that's it. Maybe this first sell-off of the week is where it finds demand. I would need to see price react to that to really see it and show it. Otherwise, I lean towards consolidation, which looks like pushing back into Friday's levels, spending some time in the 60s. A little bit of whipsaw, it's over, we're back, kind of price action. We hit 70, we lose it, you're back in the 60s. Is it going to go to the... It probably threatens, it probably looks like it's going to go right to 60 again and then gets bought up. I'd be looking at that as a weekly view. If we don't reclaim 70, I'd be looking at like down towards 60, but not 60, up towards 70, not 70, and probably in some consolidation or compression there. Probably one drop gets bought up well before 60, but also 70 remains resistance, and we see that volatility really come down and has some type of compression. For it to avoid that, it's going to have to really keep this consolidation that's building here, which doesn't seem to be. If you look at the 4-hour bands, come into them, tried to push, rejected them so far. Doesn't seem to be building for a move higher just yet. And I think that overhead resistance at 70 remains fairly solid. So down would be my directional lean here, as long as price stays below the 50, below the bands, and obviously below 70. Trade wise, we'll probably get a few days. Today might have a decent range, and there could be a couple of opportunities, but I expect there to be a lot fewer intra-week opportunities, not so much volatility, as we've had it very, very high, and it's likely now where it compresses. Yeah.
markets. I, Professor Adam, stirs debate in $30 trillion bond markets. So if you read through this, interestingly enough, it seems like he's a little bit more dovish than we previously gave him credit for, which I think is worthwhile focusing on and noting, considering that the liquidity dimension is going to be very, very important to us moving forwards, and it's going to be a very strong determining factor to figuring out the shape of what this looks like moving forwards, whether that is downwards, sideways, or maybe even mildly upwards, depending on what type of structure he brings to the Fed. So, key takeaways here. Kevin Warsh has called for a new accord with the Treasury Department, overhauling the relationship between the two institutions with a new version of an agreement from 1951. A revamp could be a bureaucratic tweak with little near-term impact, but a more ambitious effort could see increased volatility and concern over the U.S. central bank's independence. Now, anytime you see a concern over the central bank's independence, that is code word for up, effectively, because as you would be aware, effectively, Donald Trump is putting this man into his position because he believes he's the right guy for the job. He wants those rates lower, however they're going to get there. A new accord could spell out that the Fed would only make large-scale Treasury purchases with the Treasury endorsement and lay out a plan for the Fed to shift its portfolio to bills, which could have implications for the bond market and Fed's independence, happening a second time there. So, Warsh floated plenty of ideas about how he could run the Federal Reserve during the campaign for his job as chair. For Wall Street, few are as cryptic or potentially consequential as his call for the new accord with the Treasury Department. Looming over any Fed talks would be the Trump, who last year argued that one of the central bank's duties in setting interest rates is to mind the government's debt costs. Those are currently running at an annual clip of around $1 trillion, or half the budget deficit is attributed just to the interest repayments. Rather than insulating the Fed, it could look more like a framework for yield curve control. Tim Dwyer, chief U.S. economist at SGH Macro Advisors, said of an accord, a public agreement that synchronizes the Fed balance sheet with the Treasury financing explicitly ties monetary operations to deficits. This is one of the most interesting pieces that we could have possibly seen regarding Warsh's position on monetary policy and where that's going to be going for liquidity. Again, I'm going to very, very explicitly highlight what we're seeing here. A concern over central bank independence, not once but twice, and explicitly labeling his interests in managing the deficit debt costs as yield curve control. I cannot make this any clearer. We're facing with the possibility that Warsh is actually not going to be as hawkish as we previously suspected. Perhaps it's going to be more along the lines of bullish. Now, I know that this would possibly run against Darius Dale's analysis, as he's saying that Warsh is potentially going to be more, a hawkish type of Fed chair. But he did also say that the deregulation could possibly be over and beyond any potentially tightening that he would have at the balance sheet level. And now we have this report from Bloomberg stating that what he's going to be doing possibly is watching these deficits and watching the interest rate costs of this government debt and applying a very proactive kind of Fed policy of interacting with this to try and get those costs as low as possible, which would be effectively, in simple terms, a form of yield curve control. And this would be definitely not a variation of Fed independence. This is very much Fed cooperation with the Treasury Department. If you don't understand what I'm talking about here, it's very, very important to understand, because this means, if true, liquidity up, which kind of coincide with Lynn Alden's report, which was released yesterday, effectively saying that the Fed is probably going to be deploying this, and she's saying that this is more likely than not, and that nothing stops this train. So every single time when I mentioned that Lynn Alden said nothing stops this train, basically her analysis of the current situation reinforces that. I'm not going to go into depth on that for the moment. Suffice to say that basically my current beliefs of at least this, let alone stable through this period and possibly maybe even flat moving forwards. Obviously, we will watch the liquidity rate of change to determine our views on this, but nothing is changing from this perspective. Up is the name of the game. Obviously, we have our cycle frequency analysis, which was a key point of yesterday's text investing analysis, noting that there appears to be a very interesting coincidence forming between BTC price and its harmonic frequency analysis and the inflection point here that we have in monetary policy. There could be an interacting factor here between liquidity itself and BTC price, considering the two are almost completely correlated. However, to see this coming out directly out of price information, while they're also speculating on the direction of future liquidity and this relationship, very, very cool to see that overlapping coincidence. So I'm feeling very, I don't know how to say it, basically happy and satisfied with my views on this and for the near term, looking out into the near term. And this is also in alignment with my macro environment indicator, moderately positive. So staying optimistic, because that is effectively not only what the quantitative data is showing, but also the qualitative kind of reporting and what we're seeing here. So that is the most interesting macro news for today. Obviously, price action on BTC. Nothing much going on there, and gold moving slightly upwards. I do have a little bit of an interesting analysis here for you today on a product that I found. 21 shares Bitcoin Gold ETP, which is very, very cool. But I will cover that in due time. We'll get through the on-chain stuff first. Obviously, valuations at extreme levels, and you'll see this across the board. Interestingly enough, Checkmate's intermediate term model is signaling a bottom. That has happened. Finally, it's triggered off a signal, which is very interesting. You could say that this is very similar to the COVID crash. I don't believe it's similar to this at all, considering where we are in the long-term kind of power law style models. Any ultra long-term models, we are very, very low as far as the pricing floor is concerned. And to see the intermediate models firing off at the same time is very encouraging. So moving forwards, you would be familiar with the short-term holder supply and profit and loss ratio at extreme levels and now finally recovering. Same thing with the short-term holder MVRV bands and the MVRV indicator itself coming out from extreme levels. So moving into the crypto quant dashboard, you can see here the risk off signal, which was previously quite messy through here and triggered once during the, there was the yen carry trader unwind through this consolidation here as well. After the October 10th crash, here during the first leg of that downtrend, and now we finally have it triggering on the next leg of this downtrend here. You can see that has finally started triggering there and giving us a red indication. So as far as its historical correlation with bottoms is concerned, that is what you would describe as a bottom. Of course, that also there was part of this high volatility collapse, the FTX collapse there. So multiple bottom indicators firing, which is quite cool to see that coming in the moment, which is also in coherence with all the other indicators that we have. Short term, you can see that moving average there moving into buy territory. Again, with the BTC Futures Sentiment Index, that moving average, if you were to take away that headline index, you can see the moving average moving into buy zone, which is typically a short-term buy signal, which is good quality. CDRI also in buy territory, and the funding is now starting to move back a little bit neutral here. And across the board. So basically the quality of this bottom is very, very good. We're seeing negative funding, not just on the daily clustering, but also on the weekly, like I mentioned there, which is just great to see. When you see clustering of daily and you have a weekly negative funding bar, very, very high quality to see. CoinAlyze looking like it has negative funding as well, moving very fast forwards, open interest, confirming bottom as it has previously. Lots of shorts beginning to stack up in price. This is Model 2, so we are looking at all of them. You can see the long side is pretty much empty. Nobody is willing to long this market. And you can see that starting to play out with the 7-dayer as well. I don't want to get into the 24-hour cross-sectional maps. I think the 7-day does a better job at looking at the quality since the drop. And you can see a lot of clustering here. People are betting on a resumption of that dip. I think it's more likely that we're going to continue moving upwards in coherence with this map here, just over the short term. But of course, that's just speculation. Moving into the sentiment, this Centix update came through my email. So this is the latest reading for short to medium term Bitcoin sentiment coming from institutional players, and you can see they're very, very low, lowest since that high volatility drop coming out of the bear market in 2023, and that is the lowest that it's been all cycles so far coming through this bullish phase there. So good to see. Basically shows that if you are a buyer here or you are accumulating as a long-term holder, you are probably on the right side of the trade. Additionally, net realized profit and loss breakdown by year. This one from Checkmate here also showing us that very, very high quality location to be accumulating if you're an SDCA enjoyer. And a great one here from James showing us the Korea export overlaid with the ISM. I think I've shown you this one before, just to show you that there is still a possibility of the ISM teleporting to 60 and a huge amount of risk sentiment probably coming back into asset markets. But we will see how that progresses over time. So moving into the graduate questions, going to keep this one very short today. We have a couple of interesting ones here. Hi, Prof. Would the following chart be an input for an SDCA?
Market is about to open. Ahem.